Welcome. My name is Len Lane, and I am the founder and president of Brokers for Life, Inc., and we are Dominion Lending Centers in Western Canada. The topic of our podcast will be about what we consider to be real-life mortgage solutions. Welcome back. Today, we're in session 3 of talking about the different types of lenders in the market. We've talked to some of our mortgage lenders on the A side, as we call it. We've also talked about CHIP-type mortgages. They're called reverse in some of the different parts of the industry. CHIP is probably the most famous, but Bloom was our last guest. So today, my guest today is Mike Ayub, a longtime employee with one of our lenders called Home Trust, quite large in the B side of the market. And so we're going to kind of get rolling today and welcome Mike Ayub to the studio.
I want to thank you so much for allowing us to come today, Len. Home Trust has been a part of the alternative side for over 30 years now. A little background on myself and the company, of course. Home Trust started back in 1989, back in Toronto. We're across Canada now. Myself, I'm going into my 16th year with Home Trust. Started in Halifax, took care of the Atlantic Canada division for about 14 years, and been in Alberta now for another 2. Still actually taking care of Atlantic Canada by a weird coincidence. But I think it's one of those situations where, I think the alternative side has always gotten that interesting, I don't want to say stigma, but it's always kind of got that part of it that, people think it only belongs to a certain client, where we know that that's different. You yourself has even mentioned that this year it's changed a lot. Couple of different things. The market has definitely changed. That's the biggest part of it with Home Trust. With us dipping our toes a little bit into the insured business there for a little while, of course, with the sale going through to Smith Financial last year, we went back to focusing basically on our bread and butter. As when you do submit a deal to Home Trust, it is Home Trust Classic. It's our classic business, which is alternative side. So I think that's where we find ourselves. We have an interesting niche in the market, and it's been extremely successful for us for 3 decades now. So.
Yeah, it's hard to mess with what's been working, right? We've seen it more times over the last 17 years of doing this. Actually, 18 years as of last week. Lenders morph, I guess, if you want to call it that, into trying to do other things when they have a base like what Home Trust had in on the B side, soft B side, I call it. It's hard to try and make yourself something else in the market when the market already loved what you were doing on the other side, right? So Home Trust around a long time, a lot longer than I realized when I did some research. So maybe a little background on how they ended up in the B side. Do you know that part?
Yeah, of course. Jerry Soloway, which is our founder, started a law firm, got into home loan and savings back in 1989. Started out when he realized there was a need in the market back in the late 80s. And then started a small little office in Toronto, which is now, obviously grown to branches all across Canada. We're big in the industry, and I'd say probably the premier alternative lender we have for over 30 years. The other part of the industry is that the background has always become, we've always basically focused on finding those clients' homes is the most important thing. And I think with us, we've always decided that was our opportunity, because there was a form of the industry or a part of the market that just wasn't being fulfilled when it comes to, the quote unquote mainstream financial institutions. And I think that's where alternative lending has come into place. Over the years, it's changed a lot more. It's morphed into a lot more. So as we've grown, we have branches in Halifax, Montreal, Toronto, Calgary and Vancouver, because we want to localize all our underwriting to those clients. And when I say our clients, our clients are mortgage brokers. But we want to make sure that the understanding of what's going on in the industry and how much we become a niche type of lender, because when you do alternative business, you are a niche lender, and that's what we have been from the beginning. I think that's the type of lender Home Trust has always been. We want to, you can't fit the old circle and the old square peg all the time, and I think it's one of those things where we've come to the decision that there's a part of the market that needs to be fulfilled when it comes to unique products. For example, I'd say, if I had to pick the typical home trust client profile, if you don't mind me talking a little bit about it, Len, I think that's one of the things we want to look at. Our typical client profile is a client that, quote unquote, just doesn't fit into the major banks situation. So a typical client profile is somebody who, has a business for self industry or an incorporation or has any type of income or situation that just doesn't fit into the regular A guidelines, as we want to put it. I don't want to put an A word on it because, they're not technically B customers, but that's what we're looking at. We're looking at those clients that just don't fit into that A world when it comes to stated income or self-declared income. So they may have a great cash flow. They may have great income coming in from their business or any type of commission work that they do, but they just don't have the quote unquote 2 year history, or, they don't declare enough to CRA. They don't declare enough income on their taxes to meet that 2 year history that the A lenders want, right? And I think that's where we
Right.
slide in.
And that's a big part of the market, I think, that we've seen change over the last 2 years for sure, especially with people with heavy debt load. That somehow seems to, we're seeing files where, credit card debts and things like that are in that almost, most of them are in the 6-figure range, right? So when you have to debt service that and pay it out, sometimes it doesn't work with the bank. It doesn't, or the bank doesn't want to do that, right? So it's become an option, I think, for a lot of people, whether it's short term or not, is to be seen. But to get into a higher debt servicing ratio, even though they can afford it, because once you've paid off $100,000 worth of debt, it makes a big difference in the stress in your life, right? So.
That's a great lead in because I think, Len, we've noticed it, obviously with the rising interest rates in the last 2 years, which, I think people are so tired about hearing about. I think that's why our client profile has changed so much from the alternative side you would see 10 years ago to somebody in the last 2 years, right? We have a lot of higher beacon score people that, typically would have fit into that A world, but just don't fit because of their debt ratio, where a typical A lender can only go to 44% of the client's debt situation, where here on the alternative side, we can go to 60%. So we have a lot of those clients that are falling into that gap because they just don't fit under the 44%. It had nothing to do with their credit and had nothing to do with their situation or their income. They just don't fit into that debt ratio. So that's where we've seen a higher number of higher beacon score clients, fall into that alternative side, whether it's just short term for 1 or 2 years, just until interest rates get themselves back in, or we've gotten them into a better position to move on to an A situation as well.
And that's that client score. That when you talk about the beacon score, it's like, yeah, we're seeing 700 plus, which at one time was golden. It's kind of average now these days, I guess, if you want to get an A lender. But but incomes are there. They just have themselves in such a position after the pandemic and after all of the rising interest rates that went up so quickly.
Oh, of course. I mean, I think that's one of the biggest things that we're seeing more and more now, especially when you're focusing on self-employed, incorporated, and commission income clients, which is a huge bulk percentage of our business. The reason we do have to do that is that because that client could have a high beacon score, great income in all that situation, but the A lenders have decided to pass on that because of the outstanding CRA debt. So we would fill that niche for them, whether it's just a short-term situation. Typically, like yourself, if you brought that deal to me, I would say, Len, let's put them into a 1 year term, pay out the CRA date, and then you take them back the next year into one of our, our partners in the A world to focus on something like that as well. Because again, there's another customer right there who have excellent credit, excellent income, but just has fallen into a CRA situation, which we can help out with, even though it's only short term.
And it's funny. I'm talking with a trustee on one of our episodes, and it's like people didn't realize that CRA debt, the interest rate on it went up with the Bank of Canada, right? You're paying 9% on CRA debt, so it's if you can find a way to get rid of them faster, it's that's a good alternative. So you talk about self-employed. What other types of programs do you guys have a lot of success with?
I think our biggest, and we've seen it in recent months, especially when you're dealing in the Alberta market. Everybody's heard the news. Alberta is the hottest market in Canada right now, and I think with the huge amount of migration that's coming to Alberta, the rental market has exploded. I mean, you have definitely have seen it. I think it's one of those situations where we've decided the rental market has another niche for us as well. I think with the rental market, we allow up to 10 properties. But on top of all that, we will go to 80% loan to value on those types of properties on refinances and purchases. But those questions about those clients that are self-employed and commission, we allow them to do the stated income situation where they allow us just to show 12 months of cash flow and allow them to buy, those rentals, as well as give you higher percentages of rental offset. So if a client's got a current rental property outside of where they're looking to buy now, it's a non-subject, we'll allow you to use 95% rental offset, where some of the other institutions may not allow you to do so much. And then, of course, the subject rental will allow you to do 80% add back. So it's a lot more flexibility. Plus, I mean, what we talked about earlier with those clients, with those situations with their debt ratio, we'll allow those clients that are purchasing rentals to use the 60% debt ratio percentage that they would not normally get with, say, one of our premier lenders on the A side, right? So, yeah.
Yeah, the offsets are pretty amazing when you hit into that 80 and 95% kind of numbers. That doesn't exist on any of the worksheets, regardless of how hard we try to squeeze the numbers, right? So yeah. So what are some of your other unique products?
I think what we've seen more and more, because since we were just touching on rentals, I know you have definitely seen a lot more with clients, more and more getting more understanding of what the rental market looks like when it comes to investment properties. Purchasing in a holdco has become a huge part of our business, especially in the last 48 to 72 months. So we allow clients to go to 80% again on those holdcos. Everything we just talked about for personal rentals, we've done the exact same thing for holdcos. But we also allow the clients to purchase them in operating companies, which is another very unique product to Home Trust. So, you get the same guidelines. You're still allowed to use the 12 months of cash flow, self-declared income, 60% debt ratio to play with. And again, the 95% rental offset for non-subjects, 80% add back on subjects. It gives you a lot more flexibility, especially when clients are trying to build an investment portfolio. As you're starting to notice, that's a huge part of a lot of people's businesses nowadays. It's very rare to see a client only own one property nowadays, which is incredible nowadays. I mean, we have a lot more smarter industry consumer out there, right?
Yeah, it's actually just working with one of our new agents and the client that he's brought in has 5 already. A couple of them are paid for, so that kind of helps everything. But it's like, going to hit that brick wall with the bank, because the bank would only have 5, maybe not 5 with them, even just 5 in general, including your principal residence in a lot of cases, right? So being so is it 10 doors or 10 titles?
It's 10 titles. So you have a client that can have 4 doors on each title. So yeah. I mean, I think the flexibility gives them a lot more room to play with. I think, when you're dealing with the holdcos and operating companies, you have a lot of, like I said, a lot more smarter consumer out there. But you know what? We also want to give clients more opportunity to be more flexible with, another one of our unique products, which kind of leads into it, is that I don't like to call it that word, but it seems to be the big touch word now. We have a lot of clients that have what we call COVID mortgages. And when I say COVID mortgages, they have low interest rates in the ones, and they're looking for a little bit of extra money. And, with the rates where they are, Home Trust offers the Equity Line Visa, which is a HELOC product that we offer. And it's a little bit more unique than you would say for some of the other HELOC products that you see out there, because we not only allow you to use stated income or self-declared income from the cash flow, the 60% debt ratio situation, we allow you to put it on not only just owner-occupieds, but rentals. But here's the best part of it, Len, and we allow you to go behind any lender. It doesn't have to be us. And that's what makes us the most unique product in that. So you can have a typical client profile could be somebody who's got a $300,000 mortgage at 1.98% with one of the major institutions and only needs $90,000. So we put a HELOC on that. It's a fixed rate. It's an open product, just like any other HELOC, and the client can pay it off at any time with no penalty. And that gives them the opportunity that yourself, as some of these COVID mortgages are coming up for renewal, they'll just merge it together, refinance, and pay out our HELOC. But we give them that access to that funds to get them over that hump, whatever it's renovations, vacations, any type of credit debt situation that they want to take care of. And they don't want to touch that incredibly great rate on their first mortgage, and they just simply take our HELOC product.
Right, and I'm personally, I don't go solicit business. It's all from past clients, but I have past clients coming back who are saying, we don't want to. We need some more money out of the house, but we have a 2.39% even, right? And it's not due until 2026, and so we're trying to match up, seconds and HELOCs and stuff like that behind it. So it's interesting to see how much, and I don't blame them. I would pay that to the last day personally, right? And then kind of do what we need to do in 18 months or whatever time it is, right, to make that switch out of there. So
I think it's great because that's where the mortgage broker has to really educate the client. I think they really need to step in there and say, look, if you're looking for this amount of money, yeah, maybe it's better for you to break your first and do a refinance. But if you're only looking for this certain amount of money, this is a much better option for you because, one, you're only going to be charged on what you use. But on top of that, you have a renewal coming up in less than 18 months. Maybe just do this to get you over the hump because it's a lot better option for you feasibly in the long run.
Right, and that's that balance, I guess, for the broker. Like you're going to 80%, so that is a viable number where we can take them back out into something else at that point, right? I still see the odd ad for 90%, and I'm going like, no, don't do that, because we won't have a place for you to go, right? Exit strategy has always been a big part of what I've taught and what the Brokers for Life has taught to new agents. It's like you might end up starting a private deal and move up the soft B, which is what I consider you guys, and then to an A lender, and it sometimes is a 2 or 3 year process, right? So having an exit strategy, is that still as important to Home Trust in the process?
Of course, I think our biggest position when you're dealing in non-A situation is what is the exit strategy for the client? Because as a broker, you are to educate that customer as we are to educate the brokers on certain products. This is what we want to have done in the long run. One of our unique products is the under 65% loan to value non-conforming product, which allows clients to have a lot more flexibility because we can go above that 60% debt ratio. We can go above the unique type of income that the client has because they are moving to a different province. They're coming from outside of Canada and starting a new life in Canada as well. This product, where we really focus on the exit strategies, to tell me as the broker, what is your exit strategy after 12 to 24 months? And the exit strategy is always going to be one of our biggest things that we do try to lend on because, not that we don't love our clients, but I think at the end of the day, every client wants to be in that quote unquote major bank institution and some of the major ones. And I think that's where alt lending and private lending has kind of squeezed in to feed its purpose. It's a short-term situation. I like to call it a Band-Aid situation to get that client to where there's a lot of clients that may never leave, and because they're always going to be self-employed stated income, but we want to help that client to get them in the absolute best position possible. That's the most important thing. So, yeah.
And we do have those. We know of one in particular client who just goes, I'm not paying Revenue Canada any more money. So here's what I'm doing. I'll be in the B market for the rest of my life and I don't care. So
we've heard that. I think, Len, you and I have heard that probably about 50 times. I think a lot of business owners feel that they've paid CRA enough and they've decided this is it. I'm not doing it anymore. And I'm willing to take the higher interest rate and situation. But I think, they do have to take something away from it. You can't blame them because the soft B situation, our rates are usually only about a point or a point and a half higher than what the A rates are offering right now. So,
yeah, that's right. Yeah. And is that? Do you think that gap has definitely narrowed over the last 2 years? I think, right?
Yeah, absolutely. The way we raise funds for all alternative lenders, we are a bank, of course. We are basically the way we raise funds is RSPs, GICs, investments. We do have our Oaken financial division that does investment as well, and Home Trust Bank as well does does, investments for GICs and all that. So it's basically our cost of funds against what we can lend it out. So I think, the gap between A and B world has gotten a lot smaller. Like, for example, our lowest rate now, we're in the low fives now. I mean, we have clients now that are taking out alternative B lending mortgages that are lower than the A mortgages they took out 12 months ago. So it's a very unique situation. I mean, I've never, in all my 16 years of history of Home Trust, I've never seen so many rate drops in 1 year in my life. So it's an interesting situation we're in right now. It's very, very new territory.
So is part of that because when interest rates were high, you would have had a lot more investors? Is that just that there's more money to go around, or?
I think so, absolutely, because as interest rates are higher, you have obviously a lot more higher interest rates you can offer on investments. So when you get higher interest rates on investments, you get a lot more investors because they're willing to park money at GICs in 5 and 6% when you're lending it out at 7 and 8% when it comes to those situations. I think, as interest rates start to drop, you're still going to get lower cost of funds to bulk up their investment portfolio because they have that flexibility, right? So.
I was a Home Trust shareholder for quite a while, and it went to 6 and got out when it wasn't. We didn't throw this on the list, but you have new leadership, one that's well known around the industry. Has Mr. Basada made a big difference in how everybody feels at Home Trust working there?
We had a situation. I mean, it's very common back a few years ago, but when Usuri did step in, it was like, and I've said this a million times, but I think I'm a little biased because I consider Usuri one of my biggest mentors, and he's probably one of my biggest heroes because he's always been a person that's always focused on the employee and what's best for the company. And, I think branding has become a huge part of his portfolio as well. But he is one of those people that's just kind of a really shines bright when he walks in the room because he is a genuine person that just wants you and the company to succeed. But I think he's one of these people that also, and it's very hard these days to find somebody that can say anything that they don't like about him because he's also a person that always genuinely wants to focus on what you're speaking about, not what he's speaking about. So, and that's a hard thing to find these days, I think.
Like I've said in the past, one of my favorite dinner guests is usually Basada. I don't know if I said that out loud, but no question that you can bet that he knows the janitor's name as well as his vice president's, right? So he's that kind of guy. That's good. That's it's an evolving industry. I think that will continue to change over the next few years. More and more people are. We still have that 2 or 3 year window where people are still going to just starting to kind of recover from COVID, not just the flu itself, but about how their finances change so much over that time as well. So there's definitely a spot in the industry for the B lenders, and we're glad that Home Trust is making a bigger appearance on our books every month. So that's always nice to see as well. So.
Oh, absolutely. And I think, as you continue to train and tailor newer brokers, I think that's the one thing that brokers need to understand, whether you're new or old, senior or a rookie. Alternative business has to be a part of your portfolio. I think it's one of those, there's no such thing as a broker says, well, I don't do B or private business. If you are, then you're missing the boat. I think, and that's why we have such great, BDMs in the Alberta market or all across Canada that, if you don't understand it, always reach out. We're always welcome to help. I mean, whether it's myself or any other industry partner, we're here to help you grow your business because as you grow, we grow. So I think that's the biggest thing we want to come across from.
Yeah, excellent.
Yeah.
All right, Mike. Well, thank you for your time today. That's some great information for not only our listeners but the broker world as well. Our reach is getting a little farther every month, and it's great to have that information for them on hand. Thanks.
Great. Well, thank you so much for the time, Len, and I do appreciate all the time you took away to get this done today. And, hopefully everybody can take away something from this, and hopefully I didn't blab on for too long. But
I know we usually go a half hour at least.
That's great. Okay, we're good then. That's perfect. Great.
Okay, talk to you soon.
Thank you.
Thanks for listening today. I hope you found the information that we provided to be useful in your mortgage journey. And remember, you can always find our associates at www.brokersforlife.ca/associates. Have a great day.